the crisis did not disappear. It moved into a quieter room. Not because every private loan is dangerous. Not because every private market is fake. But because modern finance can make risk less visible long before it becomes less real. They told you the banks were safer now. More regulation. More capital. More stress tests. And in many ways they were. The visible banking system became harder to break. The old doors were reinforced. The public dashboard became cleaner. The warning lights became more professional. But risk does not disappear just because it leaves the balance sheet people know how to read. Sometimes it moves. Sometimes it changes shape. Sometimes it leaves the loudest room and enters the quietest one. And once risk becomes private, the public does not see danger disappear. It sees silence. This is not a prediction. This is not a call to panic. It is a question. Where did the risk go? After the visible system started looking safer? Most people still imagine financial danger through banks. A bank run. A collapsing lender. A balance sheet on television. A central bank press conference. A red headline moving across the screen? That is the picture the public inherited. Because for decades the bank was the face of financial risk. It had buildings, branches, deposits, names people recognized, doors people could line up outside of. So when the system changed after the last crisis, people learned to watch the same places more carefully. They watched capital ratios. They watched stress tests. They watched whether the banks looked stronger than before. And the surface did look stronger. But the old dashboard had a flaw. It showed the institutions people already knew how to fear. It did not show every place credit could move. It did not show every structure where risk could be repackaged. It did not show every room where pressure could build quietly. A safer dashboard can still be an incomplete map. And an incomplete map can make danger feel smaller than it is. After a crisis, society wants one thing more than anything else. Proof that the same disaster cannot happen again. So the visible system gets repaired. Rules become stricter. Banks hold more capital. Supervisors ask harder questions. The institutions that failed publicly become the institutions watched most closely. And that matters. Stronger banks are not an illusion. Better supervision is not meaningless. A more resilient visible banking system is real progress. But false safety begins when people confuse one kind of safety with every kind of safety. Because finance is not a building. It is a network. If one channel becomes harder to use, credit can search for another. If one balance sheet becomes more constrained, another structure can expand. If one room becomes heavily monitored, pressure can move into a quieter room. That does not mean the repair was fake. It means the repair was partial. The system did not become simple. It became harder to see. And when the public keeps watching the old failure point, it may miss the new location of risk. Risk is not always destroyed by regulation. Sometimes it is redirected. Like pressure moving through pipes, it searches for the available path. Block one channel and the pressure does not vanish. It tests another route. It moves through smaller passages. It enters rooms that were never built for public attention. This is the quiet logic behind risk migration. The danger is not that every new channel is bad. The danger is that the public often keeps watching the channel that became visible in the last crisis. Banks became more visible. Some forms of lending became less bank-centered. Credit continued to flow through funds, private vehicles, asset managers, and non-bank structures. The shape of risk changed. And once the shape changed, the old language became less useful. People still asked, are the banks safe? But the deeper question became different. Where is credit being created now? Who is holding the risk? Who can see the pressure? And how long can stress remain quiet before the public understands what it is seeing? Private credit is not a fringe corner of finance anymore. It is no longer just a technical phrase used by specialists in closed rooms. It has become part of the modern credit system. A way for companies to borrow outside traditional bank lending or public bond markets. A way for private funds and non-bank lenders to provide capital directly. A way for credit to move without always passing through the public structures people know how to observe. This does not make private credit automatically dangerous. It can provide financing where banks are less willing to lend. It can offer flexible terms. It can support businesses that do not fit neatly into public markets. But growth changes meaning. When a private channel becomes large enough, it is no longer just private in consequence. Its stress can matter beyond the room where the loan was written. And that is where false safety begins. Not because private credit exists, not because private lending is evil, but because a growing part of the credit system can become harder for ordinary people to see. The room gets larger, but the door stays closed. Public markets are noisy. Prices move every second. Fear becomes visible. Stress turns red. Everyone sees the number change. Private markets are different. They do not always scream in public. They do not always show stress through a live price on a screen. They can be valued less frequently. They can rely on models, marks, negotiations, and delayed recognition. That does not mean the numbers are fake. It means the signal arrives differently. And this difference matters because people often confuse quiet with safety. If there is no dramatic price collapse, they assume pressure is absent. If there is no bank run, they assume risk is contained. If there is no public panic, they assume the system is calm. But calm can be a measurement problem. A room can be quiet because nothing is happening. Or it can be quiet because the walls are thick. Private risk can remain private long after the pressure begins. And by the time the public sees the signal, the system may have already spent months absorbing the stress in silence. There is a strange moment in modern finance when calm itself becomes suspicious. Not because calm is always fake. Not because every stable valuation is manipulation. But because some structures are built to reveal stress slowly. In public markets, panic announces itself. A price falls. A chart breaks. A headline spreads. The crowd reacts before anyone fully understands the reason. But in private credit, stress may not arrive as a crash. It may arrive as a renegotiation, a delayed payment, a weaker covenant, a payment-in-kind feature, a restructuring conversation, a redemption request that suddenly needs to be managed. These are not cinematic signs. They do not look like crowds outside banks. They do not look like traders shouting across a floor. They look administrative, contractual, technical, quiet. And that is why they are powerful. Because a public crisis announces itself through noise. A private stress event can first appear as paperwork. The danger is not always the explosion. Sometimes, the danger is the silence before anyone agrees what the silence means. Financial stress does not always enter through the front door. Sometimes it arrives through debt service. A borrower can still be alive but more strained. A loan can still be performing but less comfortably. A fund can still look stable while internal pressure becomes harder to ignore. The public may not see that pressure immediately. It may appear first in a lender's private discussion, in a valuation adjustment, in a restructuring request, in a redemption limit, in a quiet attempt to buy more time. None of this means collapse is inevitable. That is not the point. The point is that modern stress can be managed, delayed, renamed, and absorbed before it becomes publicly legible. The system may not say, "There is danger here." It may say, "Terms have changed." It may say, "Liquidity is being managed." It may say, "The asset is being marked differently." It may say, "The borrower needs flexibility." And each phrase can sound reasonable on its own. But together they reveal something colder. Risk did not leave. It learned to speak in a quieter language. Private does not mean isolated. That is one of the most dangerous misunderstandings in finance. A private loan may begin in a closed room. But the money behind it can come from funds, insurers, pension capital, banks, asset managers, and investors searching for yield. The borrower may be private. The lender may be non-bank. The valuation may be less visible. But the system around it is still connected. Connections do not always create disaster. They are how finance works. Capital moves through relationships. Risk moves through claims. Stress moves through obligations. The problem is not connection itself. The problem is connection without clear visibility. When stress travels through a bank, the public has a familiar script. When stress travels through private funds, financing lines, redemption structures, and institutional portfolios, the story becomes harder to follow. There may be no single door to watch, no single balance sheet to fear, no single public number that explains everything, just a network of quieter rooms, and pressure moving between them before most people know where to look. False safety does not require a lie. Sometimes it only requires an outdated map. People look at the visible system and see order. Banks look stronger. Capital looks higher. Regulation looks tighter. The dashboard looks cleaner. So they assume risk has gone down everywhere. But modern finance can change where risk becomes visible. That is the mechanism. Not disappearance. Relocation. Not fraud. Opacity. Not certainty. Delay. A system can look safer because the parts people remember are safer. But the parts they do not watch may be carrying more of the pressure. This is how risk migration becomes psychological. The public does not need to be deceived. It only needs to keep using the old dashboard. And the old dashboard will still show something real. That is what makes it dangerous. It is not useless. It is incomplete. The bank may be safer. The screen may be calmer. The headline may be quieter. And still, somewhere behind the surface, credit risk can continue to build in a form most people were never trained to read. Most people were never trained to watch private credit. They were trained to watch banks, markets, headlines, interest rates, stock prices, maybe housing prices, maybe inflation, but not private loan marks, not fund structures, not redemption gates, not covenant pressure, not delayed recognition. Not the difference between public volatility and private silence. That is not a personal failure. It is a mismatch between the old public imagination and the new financial system. The public still expects danger to appear in familiar forms. A line outside a bank, a market crash, a breaking news banner, a central banker standing behind a microphone. But the next form of stress may not arrive that way. It may arrive through a structure people do not understand, through a market they never see, through a report that sounds technical until it becomes unavoidable. This is the deeper false safety. Not believing everything is fine, but believing that if something were wrong, it would appear in a form you already recognize. And modern finance no longer promises that. The crisis did not disappear. It moved into a quieter room. And the most dangerous part of that sentence is not the word crisis. It is the word quieter. Because quiet can feel like safety. A clean dashboard can feel like control. A stronger bank can feel like a stronger system. A stable number can feel like proof that pressure is gone. But silence is not proof of safety. Sometimes silence is only the sound of risk becoming harder to observe. The danger is not that risk disappeared. The danger is that it moved into places most people were never trained to watch. And once that happens, the public keeps looking at the bright room, the regulated room, the familiar room, the room where the last crisis was explained. Meanwhile, pressure moves through the darker architecture behind it. Not loudly, not dramatically, not always illegally, not always dangerously, but quietly enough that people mistake absence of noise for absence of risk. That is the final illusion. The system did not become simple. It became private.